It is the 14th of May 2010, and I want to make a bet. Yes, I want to make a wager. And I want to make a wager on the failure of another. We've seen this within Wall Street, how we have banks and institutions who make wagers on the failures of such things like the housing market and other different stocks by simply shorting a stock. You can bet on the failure of others. And well, I want to do it in hockey. And I want to bet on the failure for the San Jose Sharks, meaning the success for the Chicago Blackhawks, as the Blackhawks and the Sharks are meeting up in the NHL's Western Conference Finals. But the big thing is if I lose and the Sharks happen to make it to the finals, and I want to make extra leveraged bets against the Sharks, I want to get bailed out if I lose. I want to get bailed out if I lose. Is that asking for too much? After all, we live in a world where making successful economic decisions is to make wagers betting against other things. That's the way this world works, it seems. AIG, look at the successful bets that were made within that organization. Now, I look at this and I notice that many of the banks made these big wagers, got bailed out, they got their bailout, and well, I recently stumbled across an article that states that these major banks had a profit every single day during the first quarter. That's 61 trading days every single day. Whether the Dow was up 80 or the Dow was down 80, they profited. Interesting information. How every single day they had a profitable sum of trades. Not every trade would have been a winner, but the accumulation of every trade in one particular day. I find that very interesting because, well, I recently just seen a video by FoxBusinessNetwork, and they had a guest on. His name was Doug Hirschhorn. I don't know how to pronounce his last name, so I'll just call him Doug H. And the host on the show was stating that politicians are comparing Wall Street to a casino. And if that information gets vibrated through the public, what's that going to do? And well, I didn't get an information on what it would do. My assumption for what it would do would get people unhappy. Maybe people may withdraw from the stock market, their 401ks, or they may decide not to enter it if they've been speculating entering the market. After all, you go to an E-Trade webpage, you go to Scottrade, Ameritrade, it doesn't matter. Are you going to find a link on their page that says responsible gambling? Most likely not. However, he mentioned that there's corruption all over the world. Mr. Doug H. did. Corruption, and it's something to not be concerned about. He then mentioned that casinos have an edge. They have an edge mathematically, and, well, the stock market, it's a mathematical game also. But then he goes on to state that successful traders play the edges in their favor. Successful traders. Not just traders, but successful traders. So he never did answer the question on whether it was a casino or not. For successful poker players, same sort of deal. They will be making money over the longer term time frame. Successful blackjack players who count cards are able to understand what to do in different situations based on the count, how much to make their wagers based on the count. They are successful over the long term time frame. Yet when we see that the banks have profited from 61 days in a row from such great lengths in dollars, where's this money coming from? Where is this money coming from? For in poker, if you see the likes of Phil Ivey, Daniel Negreanu, or maybe Howard Lederer making a lot of money, where does that money come from? Well, in poker, it comes from other players sitting at the table with the casinos making money on rake. In the stock market, the rake would be your transaction fees in which you have to pay. So banks not only are making money on the transaction fees, but they are playing the game also, making money, maybe buying a stock at 20 and selling it at 20.30, shorting a stock at 75 and covering at 74. That's what they're doing. And when that happens, your regular, everyday investors are losing. And then they state to us, the people, to buy and hold over the long run. And if you were to buy Citigroup back when it was $30 a share, AIG a long, long time ago, maybe you bought some Bear Stearns and, well, you didn't have a stop loss because you were playing for the long term, and then boom, you got your butt destroyed as the markets got hammered. And you lost. But it's not gambling. No, apparently it's not gambling. It's investing. Even though you put in, say, $25,000 and now the bank says your portfolio is worth $3,000, it's not gambling. Very, very interesting how we are being told this information. And then maybe one wants to be smart and state, well, I want to put a stop loss in just in case. I don't want to see my stock fall huge. And well, last Thursday, we seen the Dow fall 1,000 points. The average stock on the market was down 10% at one point. The average stock. This got a lot of stops out for different people. This means that people got out at a small fractional loss, maybe a break-even point, maybe a small profit where they could have easily gotten a higher profit. But when this is the case, and we see that these people are losing, are they successful traders? Is the bank successful traders for winning every single day in a row? And does high-frequency trading have anything to do with their profits? I'm really not going to make this wager on the San Jose Sharks and Chicago Blackhawks. I just wanted to make a point that there really isn't much of a difference within betting on sports and betting on the stock. Either way, to be successful, you need to make some research. In football, hockey, baseball, soccer, whatever, same deal. You have to make your research, know the players, know the game, know your stats. Same thing within the stock market. If you don't know what you're doing, you are gambling. Thank you for watching and have yourself a magnificent weekend. Bye-bye.